What if I told you that a world-class company whose stock has crashed 30% this year isn't a disaster, but is actually the single best buying opportunity on the market? It sounds crazy, but the difference between a broken stock and a broken company could be the key to protecting and growing your wealth in today's chaotic market. In this video, we're pulling back the curtain on our Q3 performance, but more importantly, we're giving you our exact playbook. You'll learn how we're managing our high-flying AI stocks, how we're finding incredible bargains that everyone else is panicking about, and you'll see the disciplined process we use to navigate the bull and bear case for the rest of the year. Let's get into it. Welcome to our September Progress Report and Strategic Outlook. This is where we break down not just the numbers, but the philosophy behind them. All right, let's look at the numbers for September. The Value-Aligned Portfolio, or VAP, was up 1.7% for the month. This trailed the S&P 500 ETF SPY, which had a strong month at 3.6%. We did, however, outperform the equal-weighted S&P 500, or RSP, which was up 1.0%. Now, looking at the year-to-date performance, you can see we're delivering solid returns, and this is all about playing the long game, which brings me to the core theme for today. This month, we're asking a fundamental question. Are you investing in companies, or are you just trading stocks? It seems simple, but the distinction is everything. Markets are driven by emotion, short-term waves of fear and greed. Prices can swing wildly based on a single headline, but the actual underlying value of a great business is far more stable. Our entire philosophy is built on a simple truth. Over long periods, true value always wins out. Let me ask you this. If a great company's stock price were suddenly cut in half tomorrow, would you stop using its products? If everyone started dumping Apple stock, would your iPhone suddenly stop working? Of course not. Your answer to that question reveals the heart of disciplined investing. And that's what our philosophy is built on. First, we run a concentrated portfolio, a high-quality basket of businesses we know inside and out. Second, we are obsessively long-term, focused on the power of compounding. And third, we only invest in quality, companies with durable competitive advantages. Now let's see where this has worked spectacularly. Our top performers this year have been uniformly tied to the AI revolution, and the undisputed leader has been Nvidia. It's up a remarkable 39.7% year-to-date in our portfolio. This isn't a surprise. They have undisputed dominance in the GPUs that are absolutely essential for training AI models, and global demand is exploding. But this success creates a new challenge: valuation. Nvidia, along with our other AI leaders like Broadcom and ASML, all currently get an F grade on valuation. This creates a strategic tension. Do we trim these incredible winners to lock in gains, or do we hold on for future growth? For now, our strategy is to trim and redeploy, but with extreme vigilance. Now let's talk about the other side of the coin. It's important to understand that even the best companies in the world can face painful periods of underperformance. Let's look at Accenture. The stock has had a very tough year, with a sharp decline of over 30%. The market is scared, pricing in an economic slowdown and deferred IT projects. But the business itself remains a powerhouse. Accenture is a premier leader in digital transformation, and critically, it maintains an A+ grade for profitability. This is the most important concept you need to understand today. Accenture is a perfect example of a broken stock, not a broken company. A broken stock is when you have poor price performance despite strong company fundamentals. A broken company is when the business itself is deteriorating. Accenture and another one of our holdings, Salesforce, have had terrible stock performance recently, but their business quality remains superb, and that creates an opportunity. Our patient strategy is designed to capitalize on exactly these moments. Look at the difference this makes. Accenture stock is down over 30% year-to-date, but because we were patient and bought during the panic, our position is only down 12%. Novo Nordisk stock is down over 30% year-to-date, but our position is actually up almost 5%. Copart is down 21%. Our position is down only 7%. And Salesforce is down 28%, but our position is down only 2%. This is the power of being a disciplined buyer when others are fearful sellers. So how do we do it? It's a four-step process. First, we identify world-class, wide-moat companies. Second, we wait patiently for market volatility to create a discount. Third, we execute with discipline, buying when others are selling. And finally, this positions us to capture the full upside when the market recognizes the quality we saw all along. So what's next? The market is at a fascinating crossroads heading into the final quarter of 2025. We're watching three key catalysts: Q3 earnings season, which will be a huge test for those AI valuations, the Fed's next move on interest rates, and of course, any geopolitical developments. This leads to two very different potential paths. The bull case is that the AI investment cycle continues to drive earnings. Inflation cools enough for the Fed to pause, and the rally broadens out to other sectors of the economy. The bear case, on the other hand, is that AI hype fades and tech earnings disappoint. Persistent inflation forces the Fed to stay hawkish, and a global slowdown finally takes hold. So how do we prepare? The key is we don't change a thing. Our strategy is built to be disciplined, patient, and long-term focused, regardless of the headlines. We remain focused on the highest quality businesses with strong competitive moats and the financial resilience to weather any storm. Our portfolio construction reflects this. We have our AI leaders for growth and our quality value names that offer tremendous upside potential. It all comes down to these three guiding principles. First, ignore short-term noise and focus on the business. Second, trust the process. And third, think in terms of decades, not days, to let long-term compounding do its magic. Our objective is simple: compound capital steadily through all market environments. We are staying the course. So there you have it, a strategy that balances the incredible growth of AI with undervalued world-class companies, all while maintaining the discipline to buy when others are panicking. If you found this breakdown valuable and would like to see more of this disciplined, long-term approach in action, be sure to like this video and subscribe to the channel. And I want to hear from you. What are your thoughts on broken stocks versus broken companies? Leave a comment below. Thanks for watching, and we'll see you next time.